Hey everybody, Matt Graham, MBS Live here with you on Tuesday, April 7th, 2020. Crazy time trying to record this video just now. It was like 15 minutes. I deleted it. I'm starting over. It doesn't need to be that long. Let me cut to the chase. Treasuries are weaker, MBS are stronger. There are different reasons for both those things to be going on, and there are different considerations stemming from each of those things. First off, Treasuries, really not super interested right now. They're weaker today. I don't really care. They're 0.72. If they're under 1.2, 1.3, I don't care. In the bigger picture, I think people are expecting that they're going to be in this low range for a long time, and that's sort of that. But if you're curious, we could talk about the fact that there is upward pressure from a few different things. One is the general move in risk assets this week, and that just means that investors have been pricing in those proverbial green shoots, buying some more stocks, selling some bonds, making bets on something economically positive, at least relative to how they were feeling earlier, or they're just playing a technical game and capitalizing on short-term swings and momentum, and we're about to move back in the other direction again. In fact, this afternoon, it did that to some extent. There's also pressure from issuance, and this is something that's going to dovetail into MBS. Issuance means that people are making more bonds for whatever reason. Right now, the government's going to need to make bonds, potentially more and more, to pay for stuff. And when the government makes more bonds, it creates supply. Supply makes prices go lower and yields go higher. It's that simple. One other source of short-term supply is the investment grade bond market, because those bonds use treasuries as a hedge, as a benchmark to create their pricing. The companies that help facilitate those deals can sell treasuries to hedge against interest rate risk during the issuance process, and then they can buy back those hedges. It's the same way that a mortgage lender may sell MBS when you lock and then buy back that hedge if it's in the money when the loan closes. That is why I think we saw this nice little move lower in yields heading into the 2 p.m. hour. Although 2 p.m. is also a hotbed for algorithmic trading, and we also had stocks moving lower at the same time. Stocks are in the blue line here on this chart from Icon, and 10-year yields are yellow. Here's the sharp move lower in 10-year yields, and sort of an accompanying move lower in stocks. And the move in stocks is big enough to justify the move in bonds. But again, it's neither here nor there. We want to see how these things are going to play out in the bigger picture. And in the bigger picture, if we zoom this chart out, Treasuries are sort of in the middle of this EKG pattern that was going crazy in the middle of March. If one of these extremes is broken, we'll talk more about it. And it's sort of the same story for stocks. If this lower extreme is broken here, or if one of these recent higher highs around, 2,900 in S&P or 3,100 is broken. Now let's move on to MBS. 2.5s are positive today. Why is that? Well, one reason is they don't have to worry as much about supply because the government isn't issuing a bunch of MBS to pay for stuff. Also, lenders aren't issuing as much MBS as they were back when rates first fell to extreme levels. And the amount of Fed buying that we do have is more than enough to offset that. And it leaves the Fed in a position to determine the price of MBS, because they're by far the biggest buyer in the market. And this week, they've been doing a really good job of keeping things steady and in a tighter range. And that range has generally been 103 to 104 in 2.5 UMBS. We only really saw that cease to be the case after the Fed was done buying this afternoon. So it'll be interesting to see what they do with tomorrow morning's buying operation, to see if they set their prices that they're willing to offer and scoop up from sellers offering loans to them or offering pools to them, such that it brings prices back down under 104. Even if it doesn't, the most important thing the Fed needs to do is just keep prices from going too crazy. And they've arguably been doing that, which is easy to see if you pull up a candlestick chart of 2.5 UMBS and just make a note of the fact that the recent candles are much smaller than the candles seen 2 to 3 weeks ago. Lack of stability is good for cash flow at lenders. It helps margins remain tighter. As we always say, volatility costs money. So when volatility is lower, lenders can have tighter margins. That's one of the reasons that rates have been able to improve a little bit for some lenders. The reason that a lot of rates are not making sense to a lot of you is really the main thing that I want to talk about for the rest of the video. And I ask you guys to send me questions to mgraham@mbslive.net or through the help menu, contact us, and let me know what you'd like me to talk about in these videos. And the question I'm getting more than anything is help me understand why my rates are different than the other rates I hear about? And the answer very simply, and one of the things that made my first go at this 17 minutes, is that it has to do with servicing. And I could go on and on about servicing, but I think the short version of the story is that when you're dealing with determining the value of a loan on the secondary market, you have a value associated with the security, which is the stuff we watch in MBS, but then you also have a value associated with the servicing of that loan. And that's typically a very stable thing. And it typically is a positive thing. But recently, due to the forbearance tidal wave and all the uncertainty that creates about, how servicers are going to be on the hook for paying bondholders if they don't have payments coming in from homeowners, the servicing piece of the pie has been all over the place, depending on the loan, depending on who is bidding for the servicing, and depending on the agency guaranteeing the servicing. And that has caused some lenders, depending on where they sell their servicing, has caused them to price loans in a way that doesn't need to make sense to you and won't make sense. And they can actually be charging you to sell them your servicing, which is pretty much unheard of in the history of the mortgage market. It doesn't typically happen, and definitely not on this scale for this long. So that is the difference between your rates that suck and other people's rates that are awesome, is you are having to do something with your servicing, and you're not in a position to sell directly through one of the agencies and then service your own loans. If you're going to stick someone else with that uncertainty right now, they're going to charge you for it, or they are going to pay you much less than they normally would for it. But in many cases, they're going to charge you for it. And if you are servicing your own loans, you are taking a risk if you are offering super low rates. And your risk is that your true cost of servicing is going to be higher than you're expecting based on how you're pricing those loans right now. So you're either going to lose money on those, or you're going to be forced to adjust your margins or servicing valuations in the future. That's basically the biggest reason for differences in price between lenders. The other question I had come up in an email was about differences in prices between rates. For instance, why is 3.625 priced better than 3.75? This one's easy to answer and hopefully even easier to understand. And it just has to do with MBS prices and the coupons that certain rates can go into. 1.125% is the magic number. If a rate is within 1.125% of a coupon below it, it can go into that coupon. For instance, 3.625 can go into a 2.5 coupon. 2.5 coupons are where everybody wants to play right now because, well, it's a long story, but suffice it to say, lenders or investors are less concerned about prepayment risk when it comes to the lowest possible coupon that has a good amount of volume and liquidity. So if a lender is looking at the choice between 3.75 going into a 3.0 coupon or 3.625 going into a 2.5 coupon, they're taking less risk if they can do the latter, because the stuff that's going to go into that 3.0 coupon has a higher risk of being paid off early because it's in a pool with stuff that has higher rates. And if rates remain low and if margins tighten up or if rates fall further, then those loans are at a greater risk of paying off early, meaning investors won't get as much interest back as they were counting on, meaning investors aren't going to pay as much for those. So there's a better value proposition for the secondary market to operate in that 2.5 coupon. So any interest rates that can fall into that bucket are going to be better priced than the next bucket higher. And right where we see the overlap or the break point between coupons, we can often see a lower rate with better pricing than the next higher rate. And sometimes that's true for the next 2 or 3 higher rates, depending on the lender. But definitely something that you will see at 3.75. That would be the not as good of a deal as 3.625. And then you would see it again at 3 or 4.25. Because if we're thinking about that 1.125% thing, 4 1/8 can go into a 3.0 coupon, but 4 1/4 cannot. Hopefully that makes sense. Let me know if it doesn't. Last but not least, and yeah, we're going to come in under 17 minutes, but not by as much as I wanted. So I'll make this quick. When it comes to locking and floating, a lot is still up in the air. A lot has to do with your lender relationships, or if you're a captive lender, whether you're retail, wholesale, correspondent. If you have been noticing more consistency in your rate sheets and you haven't seen these big jumps in and out of good pricing availability, you're in a better position to consider floating as long as we're talking about conventional 30-year fixed type stuff. Anything outside that space is at risk of getting hurt due to that servicing drama and the fact that the market's liquidity and the biggest tolerance for uncertainty exists in that conforming conventional 30-year space. So if that's what you're dealing with, yeah, there's a little bit of leeway to float. But in general, my advice has been when you see really aggressive pricing, that's obviously in the market and better than peers, it's a good opportunity to lock right now because we just don't know what sort of shakeup is going to make that unavailable. The riskier, longer term, bigger picture game is to hope and trust that this forbearance tsunami is going to be smaller than we fear and that the official response from Treasury and the Fed is on the way. Some suggestion that that is the case as soon as the SBA loan stuff is handled, but it's not in place yet. And the FHFA director doesn't seem eager to help facilitate that. So it just leaves questions in the air as to what the resolution is going to be from an official standpoint when it comes to allaying investor fears about servicing valuations and servicing uncertainty. If you want to take a risky contrarian view, and if your clients are on board with it, you could bet, if you will, on the possibility that the market has priced in peak fear when it comes to the servicing drama and that there's nowhere left to go but tighter for margins, and that prices will start to gradually reflect a little bit more of a level-headed scenario. We can hope or expect that Treasury and the Fed will be rational and logical in addressing servicer concerns and that they will indeed catch up with us as soon as they're done dealing with the SBA stuff. Those are pretty big gambles to take, but they're not insane gambles to take if you feel like you have a really good handle on that stuff. That's the only way I'd qualify that, though, is to say you better feel like you have a really good handle on that stuff from like a market research point of view. It's not the kind of thing that I'm going to advise a client or an LO about if they don't follow that sort of thing intimately. If you're not intimately involved in that, then lock the really good rates and sit tight and make game plans when you don't have access to the really good rates. And it's pretty much that simple, has been that simple for a while, probably will continue to be until we see a confirmed change, a confirmed shift in the way the market is defensively pricing in uncertainty stemming from forbearances and servicing considerations. That's the way it is for now. Back with you guys tomorrow. Have a great rest of your day.